Welcome to the program. We have a hopefully very practical and informative program on trust administration. Certainly during 2020 and 2021, every practitioner was involved, whether an accountant, attorney, trust officer, other type of estate planner, insurance consultant. Everybody was involved in at least zillions of irrevocable trusts as people sought to use exemption before the laws changed and take advantage of the laws before what we all had feared would be major changes, which didn't happen. And the question we're going to explore today is, what do we do as practitioners to help administer these trusts so that it's handled properly? Before we get started, just a couple of general comments. The handout, the PowerPoint, is available on the web console. Just click on the handout caret. It will, and you can download it. If you have any problem accessing the handout, it'll be posted along with a recording of the webinar to shenkmanlaw.com within a few days of the program. Interactive Legal and Peak Trust will also post it to their respective websites, so lots of places to get it if you don't have it. First, a quick word from our sponsor. We'll start with Interactive Legal, and we actually don't have Teresa Bush, but we have the one and only Vanessa Kanega.
Thanks, Marty. Hi, everyone.
Vanessa.
Thanks for attending. Teresa would have been equally as good. But thank you all for being here. We're proud to sponsor this webinar, of course. If you're not familiar with Interactive Legal, we provide automated drafting and other resources for estate planning and elder law attorneys. You can contact us via the email there or our website, interactivelegal.com. We have a lot of the provisions that you're going to hear about in today's program, but I love this program because it talks about what happens after you've drafted them in a system like ours, the implementation, which is obviously critical, and you don't get a lot of information on that. So I'm looking forward to the program, and thank you to the panelists for allowing us to sponsor and for presenting. Thanks, Marty. Thank you, Vanessa.
Our second sponsor is Peak Trust, and unfortunately, Nicole was not able to make it, so I'm going to make a pitch on behalf of Peak. Peak Trust Company is a full-service trust company with separate independent trust entities in Alaska, Nevada. I hope it's okay. I don't mean to spill the beans if it's not okay, but they're going to be opening an office in Delaware soon as well. So it's a wonderful way, for example, you want to have non-reciprocal spousal lifetime access trusts and have them in different jurisdictions with different institutional trustees to further differentiate them. You can do it all with one trust company. If you have a note sale to a SLAT in Alaska, you can set up your GRAT for a spillover. I'm not sure you want to do that after the CCA. That will be discussed on the program, so don't run away. In a different jurisdiction like Nevada and soon Delaware, to make independent trustees and different state laws affecting each trust. I've worked with Peak for many, many years. Since 1998, I opened my first trust personally with them, the first trust I did with them, Adapt in Alaska, and I've worked with them ever since, and they've been incredibly helpful, responsive, and professional. It's been my custom on webinars whenever possible to try to feature a charity. I think it's always good for us to learn more about wonderful charities and wonderful causes that we can support personally and that we can also suggest to clients when clients are looking for that type of guidance. American Brain Foundation is a wonderful organization that I've been very active with, and I'm thrilled to have Jane Ransom, who's the executive director, say a few words on behalf of the ABF. Jane?
Hi, thank you so much, Marty, for inviting me to say a few words. The American Brain Foundation was founded to bring researchers and donors together to cure brain diseases and disorders. And we've been, this is our 30th year. We've funded about $40 million worth of research, and we promote and invite research across the whole spectrum of brain disease. So we're giving money in Alzheimer's, ALS, epilepsy, dementia, multiple sclerosis, Parkinson's disease, neuromuscular disease, and more. There are more than 400 documented brain diseases. So this is a really great shop for donors who are affected by more than one brain disease. I know I certainly am. I have a mother with dementia and a son who's had concussion problems and a friend with multiple sclerosis. So when I give to the American Brain Foundation, I know that I'm giving to all of those efforts. Our vision is a life without brain disease, and research focusing on the full spectrum of diseases and disorders is how we're going to get there. We believe that when we cure one brain disease, we will cure many of them because of the interconnection between these diseases. So thank you very much for the opportunity to say a few words. Really appreciate it.
One last comment to make. The American Brain Foundation is closely affiliated with the American Academy of Neurology. So it gives them a unique ability to tap the most brilliant researchers and the knowledge base that the American Academy of Neurology has to help influence, direct, and inform where research dollars go. So when you have a client that wants to develop or pursue a specific type of research in their donations and their funding, it's really an incredible opportunity. Thank you, Jane. Now let's jump in.
Yes, and thank you for mentioning that. Yes. Okay. Yeah. Bye-bye.
Okay, thanks, Jane. And let's jump into our program and get started. So what we're going to start with are some of the basic concepts of trust administration. And even if these seem basic to you, I can tell you that going through some of these basic steps, we find in our practice, and I'm going to share some of the things that we do in our practice, that a lot of these basic steps are just never seemingly done. And you got to start with the basics, because oftentimes, very often, just starting with the basics, like getting a compilation of all the relevant documents for a trust plan, not just the trust document, and even that's important because too often people don't get a fully signed trust together, is really critical. So one of the first steps, and I don't want to belabor it, it's really a separate discussion altogether, is you have to clarify who you're representing. So if you're representing the client and you drafted the trust as the attorney, are you now representing the trustee? Are you representing beneficiaries? Are you representing the trust protector, the loan director, somebody that can appoint or designate a charity or a power of appointment holder? I think you'd probably answer to many of those, no, I'm only representing, and then fill in the blank. But I think one of the things that we all need to be careful of is it's not just who we know we're representing. What's the perception of the other people? I don't want someone who's a trust protector to think I'm necessarily representing them simply because I represented Ms. Jones when she created the trust. We need to be careful. We need to document it. And I think we need to inform others. And I don't mean to set that as a standard of practice. It's really just what I think is a safer approach to do it. So that's certainly one of the key steps to start with. Delineate who you're representing. Jonathan, are you on?
Yeah, I am, Marty, and I'd like to make a comment here. I can't tell you how much I agree with you. In fact, when you do a trust and you have a trustee, if you are expecting to represent the trustee as questions about the administration of the trust, about whether or not the trustee needs to get a separate tax identification number or should be using the grantor's social security number in the event it's a grantor trust, you need to have a separate engagement letter with that person. Now, you can imagine Marty asks me to be trustee of his trust. Tom has done this trust, and all of a sudden there's a lot of liability there. Well, I'm going to turn back to Tom and say, Tom, why didn't you advise me that there was real danger of me serving as trustee? Now, you may not have that kind of problem with a professional trustee like a corporate trustee, but where you have individuals involved, and you very often will with something like a life insurance trust, because there's probably going to be very, very little in the way of cash assets to pay expenses and to pay the trustee. And yet the trustee may be held liable if there's a problem with respect to the insurance. You should have bought a different policy. You should have ensured the premium was paid. You should have gotten rid of that policy and gotten another. All of those questions come up. So it would be very good in your practice to get letters out to those whom you think you will be representing, and to tell those whom you are not representing that you are not representing them and will not unless there's a separate engagement. And that brings up, of course, the question, will there be a conflict of interest, for example, between a beneficiary and the trustee? So this is something that very few of us have paid much attention to, but I've seen it come up a few times, and it's always the attorney who is the loser.
I have not seen a case where a trust protector or somebody holding a power of appointment or somebody serving in all, I mean, think about the almost, infinite number of iterations of fiduciary capacities that we have in a modern trust. I mean, there's a whole array of people. I haven't seen a case where one of them, other than a trustee, has argued that an attorney they thought was representing them. But I could see it happening, and I think we need to be careful. One of the things that we try to do in practice, but it's hard to do, and we haven't been able to get enough people to do it, is we try to get people back for a periodic trust meeting and get everybody from a trust protector, the loan director that has a loan power, the trustee, the institutional trustee, there may be a separate insurance trustee, get everybody involved in a meeting. And now that everybody in the world seems comfortable with web meetings, that should be easier to do. And what we try to get them to do is sign a sort of an acknowledgement of the status of the trust. Tom, do we have a slide on that, or should I talk about that here?
We don't have a slide on it, so you can talk about it quickly.
So what I want to have happen is, for example, let's say and it doesn't have to be just the settlor, but let's use the common example. The settlor has a swap power. If you're the trustee or you're the trust protector, do you know for sure that the settlor hasn't exercised the swap power, changing the composition of trust assets? If you're the accountant filing a tax return and somebody has a swap power, don't you kind of want to know if that swap power has been exercised or not before you file a tax return based on what you think the assets are? So I think it's really important to get people to corroborate periodically what the status of things are. And it may be very simple. I'm the trust protector of the Jane Smith 2020 Irrevocable Trust. I have taken no actions from the inception of the trust until today. Now you got a sort of a landmark, you got a milestone where you can, a touchstone for what's going on. And maybe you actually go a step further and say, I acknowledge that Martin M. Shenkman PC is not representing me in my capacity as the whatever. It's important to take a look at some of these powers and address them. And I think it also gives some credibility to the existence of these powers. I've seen too many situations where practitioners, and I'm not saying it's wrong, I'm just making a statement, an observation, where practitioners don't have somebody that has a power of appointment sign anything acknowledging that they have it. And there's no proof that they even know that it exists. Where somebody's the trust protector and they don't sign a counterpart to the trust, how do they even know that they're in that role? Do they even know they have that responsibility? What's the consequence of that? Jonathan, before I go on, any last comments?
No, Marty, but as you point out, we could do a whole 2-hour program on this topic alone. But let's move on a little bit, because there are so many important topics that we're going to try to cover today.
Now, one of the next steps that we do, and we're going to do it very quickly, and I'm going to actually have Tom explain what we actually do in our practice, which may be common. I don't know. I've never actually asked colleagues if they do what we do. But Tom, why don't you just explain quickly what we do when we get a trust in that some other practitioner has created, to sort of get the lay of the land and create a framework for further discussions and analysis.
Absolutely. So as you can see on the screen right here, we annotate the trust. So if they give us, for example, a PDF of the signed version, we'll convert that to Word so that we have the ability to search the trust, to look for particular terms, and we'll start highlighting specific provisions of that trust. So distribution, the terms of distribution from that trust, who's named as trustee, any particular powers that a trustee has, if there's decanting language in the trust, anything that we may need to both administer that trust as well as specific terms or provisions that may be required for that particular situation. We'll both highlight the actual terms and then right in that conversion of the trust document, we'll make comments and thoughts based upon the provisions within the trust, depending upon what the particular client at that time needs. Another thing that we'll do, and this is specifically for testamentary trusts, because those are established by wills, we will actually create an annotated compilation of specific provisions within the will for that particular trust. We'll do that as a separate document to make it almost like a quasi-trust instrument for that particular testamentary trust. There may be no legal consequence to that extra document because everything is pursuant to the will, but that gives a short, distinct document that the client can bring when maintaining that trust. If they have to go to an institution, a bank, to establish an account, for example, it may be easier for them if they bring a specific document stating they're the trustee, for example, that shows that the testator died. It has a copy of the death certificate attached to it. It has the specific governing for the trustee's ability to open an account with that trust. It's just a way to practically help the client deal with and administer that trust.
Let me make a quick comment. And I'm, again, not saying it because I know this is being recorded, and I don't want to have anybody ever think I'm creating a standard of practice that's going to harm another practitioner. If you're an accountant and you're preparing an income tax return, a 1041 for a trust, you want to have in your file a fully executed copy of the trust. If there have been any actions or steps taken, change in trustees, exercise of a power, you want those documents in what we'll call a permanent file. I think you also want to have an annotated version of the trust like Tom just described that's annotated for your role as a CPA. I rarely see anything like that done. But as an accountant, you don't want to make legal decisions. Even if you're a lawyer, you're practicing as an accountant, you don't want to make legal decisions. But having an annotated copy of the trust that highlights the income tax reporting and income tax consequences that could affect you or could change those consequences, right? So if there's a loan provision, maybe you want to have, an annotation or comment to yourself before filing the grantor trust return, non-grantor trust complex 1041, confirm that no loans were made to the settlor, because if that loan doesn't have adequate security, we're going to talk about this, you've changed the income tax profile of the trust. So as accountants, make sure you get something like this. Too often, clients don't understand the importance of that for an accountant. Another thing that we do, and I'll just say it quickly so we can move on, is we'll often create a quick summary of the trust, half a page summary, key positions, key concepts, is grantor, non-grantor, what does the trust own, who are the different players in the different positions. Sometimes, especially when you have a client that's got 2 dozen different irrevocable trusts, to get a quick summary is really helpful to kind of be able to get your head around it and not confuse what the trusts are. Now, Tom, this is important, but I don't think it should take too long to talk about. Why don't you explain what we sometimes call a checklist or closing binder that we create for trust plans? And folks, this may sound basic and gee, why do I do it? We just got engaged by a very, very substantial client who's got a very substantial accounting firm and other advisors, family office, the full shebang. And by our putting together a checklist like Tom's going to describe, I shudder to even tell you all the issues and missing documents and unsigned documents and other things that have surfaced. Should never have happened with family office functionality and top quality advisors, but nobody ever really did it. And I think this is something ideally the attorney should do, but frankly, if it ain't being done by the attorney, somebody in the planning team should really create this. Tom, why don't you just tell them what we do and kind of how we do it?
Sure. So I'll take some quick comments here. The closing binder or checklist that Marty's talking about is got roots in, for example, a real estate closing binder or a corporate deal closing binder. The idea here is to create a short list of the establishment of the trust, any due diligence, for example, that was done for the establishment of that trust. You did judgment and lien searches, include a copy there. And then eventually the gifts that are made or the sale transactions that are made to that trust. There are so many different facets to these transactions between the establishment, if you have an institutional trustee, the opening documents for that particular institution. There are so many different facets to creating and administering the trust that it's hard to keep all of them to keep all of them in your ideas, to be able to make sure that you're following up on all of them. The Smaldino case that recently came out is a perfect example of that. There was a lot of documents that they either didn't do or that they did incorrectly, that maybe if they had a checklist, it would have been easier for the practitioners to cross their T's and dot their I's and be able to get it done.
We've done checklists on some pretty complex trust transactions that have been, Tom, would you say up to 20 pages, some of them?
I've got one that's 35 that I just looked at the other day.
Right, and that's because of all the ancillary documents. Somebody's selling a half a dozen different entity interests to a trust. You need operating agreements, shareholder agreements, assignments, unanimous consents. You may have Hart-Scott-Rodino issues that have to be cleared on a large entity if you're making transfers, on and on and on. There's no way to keep track, in my mind, of all of that without creating a detailed checklist. And what we do is we number each document automatically in Word when we create the checklist, and those numbers and subcategory numbers correspond to the actual PDFs of the document. So when the deal's done, we assemble an electronic closing binder that could, have 20, 50, 100 documents in it. And I promise you, if you've never done this, you will find to your amazement that there's dozens and dozens of documents relevant even on a simple transaction. So this is really the foundation, the Bible, the roadmap for administering a trust, because once you put this together, you now have all the documentation organized. When you have the checklist together, you often don't even have to go to the underlying documents, because looking at the checklist gets your mind around the entire transaction. Jonathan, do you want to talk a little about workflow?
Yeah, thank you, Marty. This is a concept I came up with at Milbank. We did dozens, hundreds of installment sales to grantor trusts. And there's a lot that has to be done. I mean, you've got to make sure you've got the proper grantor trust, and whether you're going to have the client himself or herself sell it, or whether you're going to actually have a marital deduction trust actually sell it to the other grantor trust. Remember, a marital deduction trust I create for my wife is a grantor trust with respect to me. And I also can create a so-called dynasty or descendants trust for my wife and my kids. And maybe because I don't want the IRS coming in and saying, I retained an interest in the property that was sold, I don't want to sell it to that grantor trust for my family. I create a marital deduction trust and I have it sell it. In any event, these became relatively complicated and there were a lot of players. So I came out with this, I called it a workflow and project management system. And as you'll see, there are a number of steps. This goes on for many, many pages, but we're just going to go to this one, and it shows who's responsible for it, the date that it's going to be done, and whether or not it's been completed. And it's a very easy way to make sure that you don't miss a step. For example, you may want to have a UCC filing. Well, that's an easy thing to forget about unless it's on your list. Tom, if you would go to the next screen, or Marty, you would, and this shows what we basically have at the end. This is, again, prior to April 15, a gift tax return must be filed for David showing, and you'll notice that for the responsible parties, I have everybody listed, and the only real ones I have there is Alaska Trust Company, which happen to be the trustee, and Milbank Tweed, my law firm. But then I use pseudonyms, obviously, for everything else. By the way, this was also presented in the paper I did for the American College of Trust and Estates Council in 2010 called The Future of the Practice of Law. And you can send this up electronically so everyone knows what his or her or its job is supposed to be to get the transaction done. You don't want to miss a step. Remember, the taxpayer always gets the lesser of form or substance. And if you fail to follow proper forms, you may lose. And they're going to turn back and say to the attorney, perhaps the accountant, you were responsible to make sure that everything was done and done properly. So these kind of things like a workflow and project management system can really be helpful to you.
So whatever approaches you use, and we're going to give you a few more comments, please don't make light of what we're doing or think it's trite or boring. It is absolutely essential. And I said in the beginning, and I don't think it's an exaggeration, when we get a trust plan in for a new client and we try to assemble this, I don't know why prior counsel, whoever they may be, hasn't already done this. I don't know why the accountants don't have this for a permanent file. When you're doing a gift tax return, and I didn't mention this earlier, if we as the attorney have prepared the compilation, the table of contents, the index, the checklist that we described, Tom described, similar to what Jonathan's done, our checklist becomes the template from which you can then create the exhibit list for the gift tax return. I don't think it's an exaggeration that every single time we've cobbled together one of these checklists that we have found several documents missing. And I'm saying that on a recording to be fair to all of us as advisors. It's impossible. I believe it's impossible to get every single thing done. But when you go back and you put the checklist together, when you review it, 6 months or a year later when you're doing a gift tax return, it gives you a second look. You can identify things. There's always things that are missing. I don't think we've ever had a client that's followed up on everything we've told them. I would almost guarantee we've never had a client do everything we've told them. And I don't think there's a client that's ever done everything all their practitioners ever told them. So it's really important. We get very compulsive about this, and I don't mean to offend Jonathan, but I think we may even be more compulsive and detailed than him, because we'll color code these. When you get as many different players and firms involved, we've had deals where there have been 3-4 law firms involved and 3-4 trust companies. We'll color code each party's role to make sure that nobody misses anything. So if Peak Trust Company is one of 3 trust companies involved in a transaction and we color code everything green, it makes it really easy for them to identify the pieces that they have to do. I think this is the final piece in our sort of background, but I think this is so vital to the proper administration of a trust, and I just don't see it done nearly enough. And I probably would blame clients as the reason. I don't think practitioners would have a problem being thorough. I think clients sometimes get what we call penny wise and pound foolish. One of the other pieces we do, and this is my favorite tool in properly administering a trust, is a schematic. And I must admit, Tom is my secret weapon because he can put anything using Excel into a schematic. Tom, why don't you just talk about it for a minute? And when you want me to go on to the next slide, I will.
Sure. So the schematic is a great visual way to show both the client as well as the other members of the professional team, as well as everybody in the practitioner's firm, what is going on for a particular transaction. So you can set it up for a specific facet of a transaction. And Marty, if you can go on, I'm going to show, we actually have a sample on the next slide of and it's cut off a little bit, but we also have it in the handout that you have, a full kind of procession of a sample transaction brought down as a schematic. So what we have right here is if you have a note sale transaction and you want to show the different trusts that are involved, the different players that are involved, the various documents that are involved here. So you can see this is a complicated note sale transaction here. This has a waterfall. It shows the different steps of this particular transaction. So the defined value mechanism has a certain amount of money that's going to go to a donor advised fund first. That's to base it off of the Christensen case, where they had there a full amount going to charity, but at least here we have a slice going to charity. So you're using established, and we're not going to belabor this point, but you're using established cases as part of your note sale transaction. The schematic helps show that. It shows where the different players are going. So it shows the sale between John Smith and his 2020 Irrevocable Trust. It shows that he's receiving a promissory note back. It includes the terms of that. It shows that there's a down payment. It will include the interest rate. This gives you a single one-page breakdown of the main terms for that particular note transaction. And you can do several schematics that show the different steps of a transaction. So if you have a gift component to it, if you then have a sale component, if you want to show the ownership of the entity both before the transaction happens as well as at the conclusion of the transaction, This is just a different way beyond having a written checklist to show what's happening with that particular transaction. Between the schematic and the checklist, it gives you a way, especially when you have hopefully an update meeting annually with the client, it gives you documents that you can sit down with and say, okay, what's been completed? What do we need to look at to make sure that we covered it and that that particular piece has been taken care of?
I find the schematic the single most helpful document in my entire practice, because when a client comes back with a complex transaction, this is one phase of a note sale. This particular transaction, which I recall when we created it, probably had 4 or 5 pages for each note sale transaction with all the different steps and different components. With this particular client must have, I'm guessing, 15 irrevocable trusts. I can't possibly remember, and I don't know how the bookkeepers that are doing payments can remember which trust owns what without a schematic. And to me, when a client comes back for a meeting or calls up with a question, I pull this up on my laptop, I can kind of get my head back around the transaction. So that's our introductory foundation. And again, I apologize if it seemed trite or trivial or too long, but that to me is some of the most important non-technical ways, practical ways to help administer a trust. And if you have a better mousetrap that works in your practice that we didn't talk about, please email me. I'd love to hear about it. But for 40 years of dealing with this is the best I've come to, and hopefully it's of help to all of you.
Hey, Tom.
Yes, John.
Yeah, Tom, let me ask you a question. What software do you use in order to create that schematic?
So I use Microsoft Excel because I found every single transaction, every single client is so unique that I need the ability to create it from scratch almost every single time. And one point that I didn't mention is we'll also create, after a client's done with their planning, or at least they've reached a stopping point, a schematic that shows all of their trusts together and the various assets that they have. We try to boil them down as best we can to a singular page so we can show the client where they are after the transactions have been completed and get pretty much their entire financial life, if we can, onto a single page, easy for them to see.
Jonathan, that's actually a great question. And we have spent a fair amount of time over the years looking at different software packages that flowchart transactions. But just as Tom said, we've found that each transaction seems to be so different that you kind of really need to tailor them to the client. And the beauty of what we can do on our own is we can condense stuff. I've even done this for myself personally. But my my transactions fit on one page because I'm not I'm not at the level of most of the clients that we help. But I believe in this, and I've done it for myself, and it's incredibly helpful. And as Tom said, when transactions are done and clients are trying to get their head around all the work we've done for them, if we can condense the entire transaction or 2, 3, 4 segments of the transaction to a page each, it makes it really easy for everybody to understand it. And it's really quite helpful. So let's get into the administration of trust. Jonathan, one of the things that I saw a lot of in 2021, and we certainly did a lot of it, was build in a disclaimer mechanism in a trust. Can you explain that and tell practitioners in terms of trust administration what they might want to look for now in 2022 based on 2021 transactions?
Well, if you want to undo a transaction, probably the simplest way, at least from an estate and gift perspective, is to have the recipient do a disclaimer. For example, if I make a gift to my son, he has 9 months under New York state law, or if I do it with an Alaska trust under Alaska law, to reject that offered transfer. He does a disclaimer, and as we all know, under Section 2518 of the Internal Revenue Code says, if you do a qualified disclaimer, which is a refusal to accept the property, and you have to do it in certain ways, then the transaction is treated as though it's never actually been transferred at all. And that means, for example, that if you've made a transfer which you were confident under current law was not estate or gift taxable, but it turns out because of a change in the law, which could occur either by legislation or a case, for example, you can have the recipient refuse it. Now, there are issues about whether or not you can make a disclaimer with respect to certain assets and accept others. The regulations make it very clear. So if I offer my granddaughter both Whiteacre and Blackacre, she can disclaim Blackacre and it will be treated as though I never transferred it. But she can accept Whiteacre and that will be hers, and there will be consequences to that. That makes an awful lot of sense. Now, those are estate and gift tax rules. It doesn't guarantee that they will be accepted for income tax purposes, although by and large, the Internal Revenue Service has accepted that. That often comes up, for example, with respect to qualified plans or IRAs, where you have, I'll call it, a bad recipient of part of it. For example, you leave your interest in an IRA partly to a family member and partly to charity. Well, charity can't be a designated beneficiary, which means everything has to be paid out in 5 years. But if you do a disclaimer by September 30 of the year following the year in which the owner of the IRA died, then that will be accepted and you can go forward as though it was never transferred to charity. So you can pay charity off, or charity in theory could disclaim it, although I don't know why it would. That makes an awful lot of sense. There are complications when you deal with a trust. For example, if I create a trust for Tom and for Marty, and I'm hoping they will disclaim, remember, I can't retain the right to force them to disclaim, or it's not going to be a valid disclaimer or a qualified disclaimer within the meaning of 2518. So what I do is, when I do this with a trust, I name one individual who can disclaim on behalf of everybody in the trust. So I might take my oldest child, or I might have my wife. And in fact, in prior presentations we've made, we've actually shown you language, and we could give you language to show that that one person could disclaim on behalf of the entire trust. That becomes very important, because if under state law you have multiple beneficiaries, and you certainly will, some of whom will be minors or unknowns, because you say, pay it to my wife, and then pay it to my kids, and then pay it to somebody else, and then it goes to my heirs at law. Well, you may have to get the permission of everybody. And if you have minors, that becomes extremely difficult. But the law seems, I think, quite clear that you can designate one person. So in this trust for Marty and Tom, I might say that Tom can disclaim on behalf of everybody in the trust, not just himself, not just Marty, but their descendants as well. So that's something that really should be considered to be done.
Jonathan, do you know why I was smiling when you said you were going to set up a trust for me and Tom?
Why?
Well, I thought last year your inventory of books on carryover basis would have been very valuable. I'm kind of guessing, since the Democrats don't look like they're going to pass any major tax legislation, that perhaps you were going to gift Tom and I the inventory of your carryover basis book now.
Well, I only have one, and it's quite worn, but someone suggested I do a non-fungible token, an NFT, of my carryover basis book. So maybe it will become very valuable, especially if Congress sometime adopts a carryover basis as opposed to a complete step-up in basis system.
So folks, and Tom, email me and remind me. We should probably let clients know. I'm not saying this is a standard of practice, but just a suggestion. And Tom, if I forget, you'll email me. We should let all our clients know that if they have a disclaimer provision and they want to unravel a plan because the changes in the law that all of us kind of really thought were going to go through didn't, and don't look like they are, but can't be sure, they got to act within 9 months or they lose that opportunity. So keep that in mind. Jonathan, do you want to explain just quickly, the Q-tippable trust and what decision people may want to make from 2021 planning that could be Q-tippable on the gift tax returns that they're going to file by October of this year?
Yeah, in fact, Marty, this comes to me because I may want to use some of my remaining gift tax exemption. I've got plenty left. I may want to use part of it, but of course there have been threats that they're going to cut it back from the current approximately 12 million down to 6 million, possibly even as low as 3.5 million. Well, what I can do is, I'm not positive I want to use it. It might depend upon the value of the property. For example, let's say I make a gift to a Q-tippable type trust, and the value of it goes tremendously up in value from the date that I put it into the trust until the time that I have to determine whether or not it should qualify for marital deduction treatment, because that doesn't have to be done essentially until I file my gift tax return. So if I make a transfer this year to a Q-tippable trust, it's not 9 months from the time I make the transfer, where my wife, for example, could disclaim and it would come back to me. But we've got until October 15th of 2023 to decide whether or not I should, in fact, have that property qualify for the marital deduction. If I have it qualify for the marital deduction, there will be no gift tax effect. In fact, the trustee could give it to my wife and my wife could return it to me. Now, I wouldn't have that wired with your spouse, but you could later go to your spouse and explain that could be done. But let's suppose that the property goes up enormously in value. I invested in Bitcoin and it's gone up tenfold from the time I put it in that marital trust. Well, I might be willing to use my gift tax exemption on the value of the Bitcoins that I transferred to the trust at that time, but now I don't want it in my wife's estate when she dies. It's 10 times greater if I put a $2 million of Bitcoin in there and it's gone to $20 million, or maybe it's Tesla, or it's the Russian ruble, which right now is selling for under a penny per ruble, and maybe you think that that's a great investment and it does go up tenfold or 50-fold or something. You could do phenomenal estate planning by not electing Q-tip treatment. You use exemption. Your spouse can benefit from it for the rest of her or his lifetime. They can have a power of appointment, and if there isn't one in there, you can probably grant your spouse one through a decanting, who then could exercise it and have it put in further trust for you if your spouse predeceases you. This is an extremely powerful strategy when you're married. Now, obviously, you've got to really trust your spouse. You've got to love your spouse if you're in that 9th marriage situation. And believe it or not, I once had a client who was in the 8th marriage situation. Their feelings of wanting to give property to that 8th or 9th spouse may not be as great as wanting to give it to the kids. But when you're in a happy, especially 1st or 2nd marriage situation, where you're going to have descendants of the common unit succeed to the property in that trust, you may not want to have it qualify for the marital deduction, so it won't be subject to estate tax when your spouse later dies. Very powerful strategy. In a lot of ways, more powerful than a disclaimer.
So here's where I can see a disaster happening, folks. I'm going to be blunt. We have seen many clients have their accountants prepare gift tax returns. And my guess is they bill less per hour than I do. So why not have them do it? It's only a gift tax return, right, Jonathan? It's a pretty short, simple return.
Right, Marty.
Anybody can prepare a gift tax return, right?
I mean, it's as uncomplicated as can be, right, Marty?
Absolutely. I do think that there are many practitioners that are not experienced in this specialty that look at a gift tax return and say, oh, that looks pretty simple. I can do that. And suffice it to say, bad move. But what we've seen happen is many of these accounting firms that have been retained by our clients, and I believe it's the client's cheapness that's the responsible cause for this, to prepare and file a gift tax return. And instead of preparing it and saying, you know, client, let me pass this by the attorney that did the planning just to make sure what we did works and reflects what was done, they're going to file it. They may see a Q-tippable trust. Gee, this certainly looks like a marital trust. It was absolutely designed to be a marital trust, and not understand the planning Jonathan explained. And they're going to file making a marital deduction election on the gift tax return, and no exemption would have been used when that may have been the intent of the client. And in 2026, the exemption is getting cut by half, barring a change, which may not happen. And the entire plan could be undermined by somebody filing a return that doesn't understand it. So let's all be careful and keep that in mind. Tom, Have you ever seen, have we ever seen in our office somebody that did a Wandry clause and it not be reported properly?
It almost feels like every single laundry that we've done, at least one of the documents did not have it reported properly on it.
So why don't you just give a 30-second, because everyone probably knows what Wandry is, but just give a 30-second explanation. But let's talk about some of the different areas that we look at in terms of trust administration, because I think the kind of things that we look at go beyond what some people look at, and that's why we identify issues and we correct them. And I'm in some cases, like the bank reporting, I'm not sure there's a problem with correcting it after the fact. But why don't you explain what it is and explain as many things you can think of, and I'll see if I can catch any that you missed.
Sure. So a Wandry defined value mechanism is, rather than transferring a percentage of an entity, you're just transferring a dollar value of that entity. So rather than giving 100% of XYZ LLC, I'm transferring $1 million of the entity interest in XYZ LLC, which we estimate to be 100% of the interest. So the nuance there is, even though you are attributing a percentage for administrative convenience, it's only an estimated amount, and that will be adjusted based upon the value is finally determined under a gift tax or state tax audit. So that particular nuance needs to be transferred to the various documents that report the ownership of that entity. So that can include many different documents. That can include the gift tax return 709. You want to make sure that you're saying the gift that was done was a dollar value, not that you gifted a percentage. It can include a income tax return, a 1040 or a 1041, both for the trust as well as for the entity itself. So the entity will have a Schedule K1 that states the ownership of the various either members or shareholders of that particular entity. You want to make sure that the K1 for the trust that you gifted or sold that interest to, that the Wandry is under, specifically states it's a dollar value, and that is administrative convenience that you've estimated a percentage there. Another important point is, if you have an institutional trustee, they may list all of the assets of the trust on the statement that they put out, that they create for that particular trust. Make sure that their statement shows that they don't own a percentage, that they own a dollar value, and if they have it, say it's an estimated percentage there. The main point, and this is brought up in the Small Dino case, you want to make sure that all of your ancillary documents reflect the transaction as it was completed, because the IRS or anybody that challenges these transactions are going to look for that weak link and try and argue your transaction was illusory. Look at what you've done on all of these ancillary documents. You're not really reflecting it as a dollar value. You're saying it's a percentage here.
So one of the reasons that's hard with the trust companies is institutional trust companies usually have a defined, this sounds silly, but it's true, a defined field. It could be 24 characters, and they may put in 12% of XYZ LLC. What you really want them to say is, for administrative convenience, it's actually, a fixed dollar figure of $2.9 million, blah, 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 blah. You kind of have to work with them and help them figure out how to truncate it and get it right. But to me, if you have anything that indicates that it's a dollar value in that truncated thing, you're ahead of the curve, because at least now the trust company's records are consistent. Now that's a trust company. When Uncle Joe and Aunt Jane are the trustees, they probably don't do anything. Now, the reason it's also a little complicated on K1s, for example, for an LLC or a partnership that has a 1065 or an 1120S for an S corp, is you can't, in the old days, and this is showing how old I am, we used to put a little star and put a star at the bottom of the return, and we filled them out in pencil, and we'd write down whatever note we wanted on the bottom. You can't do that. You need an attached statement, and sometimes that gets lost in the works. But there have been enough cases that have commented or addressed the concern that the income tax filings aren't consistent. If you have a partnership or a S corp or an LLC, the partnership agreement, shareholders agreement, or operating agreement should properly reflect that. And if corporate counsel, not estate planning counsel, is preparing that, they may not understand the goofy nuances of a Wandry clause, and it may be done wrong. So you really need to look through everything to make sure the trust is being administered properly. And if you don't have that done, and that gets picked up, just like in the Smaldino case, as Tom said, those are going to be things the IRS is going to throw at you. And you may argue, well, you know, it's only a foot fault. Jonathan, how many foot faults can you get away with before you lose the argument?
Well, again, you're only going to get the lesser of, you know, substance or form. And one of the problems is, as you were indicating, you know, income tax reporting. You say you transferred $1 million worth of this LLC or whatever it is. How much of that income now goes to the transferee? Where possible, I would strongly recommend you make the transfer to a grantor trust so that all of the income tax reporting goes back to the client, to the grantor. That's going to help you with it. But I think you're right to put down that these are estimates only. And in fact, in some circumstances, you may want to make an actual taxable gift of part of the property, claim whatever value we have, and that may be acceptable for purposes of running the you know, the statute of limitations with respect to the amount that you have sold for pursuant to a Wandry formula, where you say I'm selling $1 million worth, and maybe based upon the appraisal, and maybe make a taxable gift of part of the interest in it and say, we're very consistent with it. We reported it, the IRS accepted it, or maybe you'll have an audit from the IRS and we'll make an adjustment in that value, and then you'll adjust the percentage that was sold.
Another place to be careful. Client submits a financial statements. Client's a real estate developer. They did some note sales that had a defined value mechanism. And they tell the bank that this particular trust owns 48% of an LLC, but it's not 48%. It's, you know, $42 million, $500,000 worth of the LLC. Even financial statements have to be right. And by the way, I remember, I can't remember the client, but I remember where I was sitting when I saw it, where a client, after years of doing planning, had personal financial statements prepared by their accountant, no less. And they had all the numbers were wrong. They were listing on their personal financial statement the assets that were owned by a trust. I said, why'd you do that? He said he needed it for bank loans. I said, you can't do that. You don't own this. And it completely contradicts all the planning we've done for years. But I had never seen the statements that they had their in-house accountant prepare for lenders. Be very careful. Try to pick up all this stuff when you do a periodic review with the clients of trust administration, because as Jonathan and Tom explained, the devil's in the details. You can't have too many foot faults before everyone starts to question what you're doing. And obviously, you don't want any foot faults. Jonathan, you want to talk about the Nelson case? And I think the important question is, if you catch something that was done incorrectly because of the mad scramble in 2021 to get work done, can you fix it after the fact?
Well, your latter point, can you fix it after the fact, of course, depends. But one thing you may want to put in your pocket is the possibility of a disclaimer. So maybe what you do is you have the beneficiary or the trustee, and under some states like Alaska, you can expressly authorize the trustee to do a disclaimer, and that way you can undo it. So if there has been a footfall, maybe that you need to start over doing that. The Nelson case is an interesting one, and it looked kind of like a Wandry case, except rather than saying that the amount transferred would be as finely determined for federal tax purposes, they said as determined by the appraiser. And the court isn't bound by what the appraiser says. And as a consequence, it was rejected and didn't protect the taxpayer from tax. Follow the language in the Wandry case to the letter. It's as finely determined for tax purposes. That really comes out of a Stacey Eastland case called McCord, decided many years ago. And at first, the lower court rejected it, but the Fifth Circuit said, nope, you can use that as basically as finely determined for federal tax purposes. That is the language that you want to use. And again, you may want to make sure that on your return, if you want to say we made adequate disclosure of the transaction, so the IRS can't come in later after the statute of limitations runs with respect to the return file, that you've done the adequate disclosure. And Marty, I think you actually have some citations to the adequate disclosure regulations. Remember, you're never going to penalize, you're never going to be penalized by over disclosing. It's the under disclosing, which will sink your ship. So when you're in doubt, do we really have to say that? If then the answer is yes. Even if you decide, well, really, we don't need to say that, put it in anyway. Give them so much they'll choke on the amount of information you're giving them. That's how you protect yourself and your clients.
And by the way, one of the most common problems that we find when we review gift tax returns prepared by others is not doing what Jonathan just said. I've seen people report complex note sale transactions, and they'll put the sale agreement and the appraisal on the return and nothing else. But there's assignments. In the Smaldino case, the dating on the assignment was a crucial fact. You know, there could be approvals. There could be, you know, a new operating agreement before and after the transfer, showing conformity in respect of the Wandry or other valuation mechanism, or the King note that's been used in the transaction. All those ancillary documents are part of what I think is really critical, as Jonathan said, for full disclosure. Let me explain real quick what a concept I kind of dubbed a double Wandry and why I think it's relevant to trust administration. And I think the bigger point is not just this mechanism that I've dubbed the double Wandry, which others have used too. I don't know what they've called it, so the name doesn't mean anything. But I think a critical point is we all were incredibly pressured in 2020 and 2021. We all were pushed to do all sorts of transactions that, had we had more time, would have been done differently. A lot of practitioners had to make transfers before you could get an appraisal because we thought the law could change any day, any minute, right? So we had to get it done, And people did transactions and later adjusted them if the appraised value came in different than the initial estimate, even apart from the Wandry, which is an adjustment for gift tax value finally determined. So what I dub is a double Wandry is one way to deal with some of the valuation issues. And what I've talked about with what I call a double Wandry is to try to address the Powell issue. So if I sell $50 million worth of an LLC to a trust, and it turns out I think it's 40% of the LLC, and the IRS comes in and says, no, your cap weight was all wrong. It's not 40 million, it's only 20 million. I'm left with 20% of that LLC still in my name, but I wanted to get it out of my name. One of the reasons I want to get it out of my name is I don't want a Powell issue. If I've had any retained interest in that entity, then myself, in conjunction with under 2036-2A, others control the entity, I may have a Powell issue. And leaving aside whether that applies to an active business or not, lots of different views, not our topic for today. But the point is, what I'll structure to make sure the client has gotten rid of all the equity interest is a simultaneous sale document. So whether I'm gifting or selling, 40 million, whatever the number is, dollar value of an entity, if I find that the let's say the Wandry mechanism resulted in 20% of the LLC remaining in my name, I have a simultaneous contract I signed at the same closing of the initial transaction that says I'm selling for gift tax values finally determined, keep in mind Nelson, to the same trust or even a different trust, even better. I'm selling any interest that were left in my name under the Wandry. Now, I think it's a clever way to try to deal with the stub issue, but from a trust administration standpoint, lots of practitioners use lots of different funky mechanisms to make things happen in the pressure cooker of 2020 and 2021, pressure cookers in the 2 years. We need, when we do trust administration, to go back and eyeball, even if we did it ourselves because we did so many transactions, we may not remember what was the mechanisms used in a particular transaction so that we know how to administer it properly. If I had this double Wandry in a transaction, we need to find out, was there a gift tax value adjustment? When the audit period ends, and that's going to be years from now, right? We need to really try to find out if the clients come back periodically. Okay, the statute of limitations is run on the audit. We believe you had adequate disclosure. Let's, do a simple document terminating that secondary sale agreement is unused. We need to pay attention to all these little things. Tom, do you want to explain the double king, or you want me to do that?
So the idea behind the double king is, well, an initial king. Let's explain a regular king at first. But the idea of a king is that rather than adjusting the percentage that was transferred and having a fixed dollar value, you're adjusting the amount that was sold, or it has to be sold, and the promissory note that was a part of it. So let's say you had a $10 million promissory note, but on value adjustment, it was determined it was worth double that. Well, you're going to adjust the promissory note to $20 million. So a double king is, what if you don't have the time to get an appraisal before you need to complete the transaction? If you're worried, such as back in 2020, 2021, that a change in the tax laws is imminent. It may happen any day. So you don't want to wait for the appraisal, but you have an idea. Maybe the appraiser gives you an estimated number. So the double king is agreeing to have two adjustments to the promissory note. The first adjustment would be, we're doing this estimated number, let's say it's $10 million. If the appraisal that the qualified appraiser is giving us comes back at a higher number, that will be our first adjustment. And then if there's a adjustment finally determined by a gift tax audit, that will be the second adjustment. So the idea behind the double king is to be able to get a transaction done when you need to get it done, even if you can't complete the requisite steps beforehand. So if you can't get an appraisal beforehand, have a two-tiered adjustment to get it done.
And obviously, Jonathan. Jonathan, one sec. Just before we transition to your comments, the key point again, which is similar to what I talked with the double wandering and a lot of things we're talking about, you got to find out what the mechanisms were that were used in a particular transaction so that you can administer it properly. The accountants need to know it because they need to report it properly. There may be changes or adjustments years later. The attorneys need to know because you may want documentation done after the fact to clean up or be consistent with whatever mechanisms were used in the transaction. The trust officers need to know because you want it reflected properly on the trust, information or statements, et cetera. So that's a key point. Jonathan, I knew you were going to want to comment about King, so no, I'll be quiet.
Marty, my only comment on this is that you very often will want to do a transaction, but you won't even know the appraised value. But what again you can do with a wandering clause is you can say, I'm selling whatever is worth as of the date of the transfer. It's not the date that you get the appraisal, but today I am selling this trust $1 million worth, $5 million worth, whatever it is. The appraisal will come in, and that's what you'll use as your estimate. My only concern with a King case is that the IRS has rejected it. In King, they said that the price would be adjusted, and the reason that the court, the 10th Circuit, respected it is they found that it fell under the ordinary course of business exception to making a gift under Regulation 25.2512-8, a regulation everyone should know. It's a very, very important one, and it says if you just strike a poor bargain, but it's arm length and free of donative intent, it will not be a gift. The 10th Circuit found that in that case, the IRS has said, we're not going to accept that. And it's extremely difficult to rely on that when you're in a family situation. And that's one of the reasons, and Marty and Tom know this, that I prefer the wandering mechanism, even though the IRS is non-acquiesced in the wandering case, as opposed to relying on the King case.
So let's go on. Some of the other things that you need to think about in trust administration is some of the estate tax planning. So it's not uncommon to use basis adjustment planning. So somebody in a trust will give a power of appointment to a senior family member that has a more modest estate to cause estate inclusion. Well, we need to monitor that. How does the mechanism work? What mechanism is used? Is it a limited power and somebody's given the authority to convert the limited to a general power to cause estate inclusion? Is there a formula? I've seen these done without formulas. I've seen them done with very detailed formulas. We have one that we looked at recently where the formula was so detailed because they wanted to maximize every possible penny, maybe fraction of a penny, of possible basis step up. that it worried me and some other practitioners that are working on this with us, that it was just too far over the top. A little, a formula, but a little less precise may make sense. And I remember hearing some presentations where people would, extol the virtues of how to maximize every penny. I remember other speakers at other conferences talking about how you leave maybe, no adjustment for charity or something. So there's some stuff on the table, so it's not every penny of maximization to make it look more real. On the flip side, which is even more dangerous, and I think we all have to start being alert to it because 2026 ain't that far away, is if you have a basis inclusion mechanism, general power, and it's not limited at all. And I've seen people draft them like that. Dad only has a $3 million estate and the trust only has, $3 million or $4 million. I'm not worried about having a tax after all the exemptions, $12 million. But hey, if the exemption is cut by half and dad has a $4 million estate and there's $4 million in the trust, bam, you've just incurred a tax cost. So I think we need to really start looking at powers of appointment. And I think, and Jonathan, you may have a different view, but I bet an awful lot of the powers of appointment that are floating around out there, they're not on anybody's radar. The beneficiaries are looking at when can I get money, and the trustees are managing, the assets and monitoring distributions. But is anybody looking at the powers? That's why I think it's so critical to get periodic, and I recommend in writing to every client, 100% of my clients, I recommend in writing that they have an annual meeting to make this planning work or it won't work. And one of the things to do at an annual meeting is you start with all the basics we talked about in the beginning so you get your arms around it. And one of the things to highlight when you review the trust are powers of appointment. And then you can get it on your checklist for annual review meetings, whether or not something needs to be done, just like a swap power. I am very worried that a lot of the swap powers that are out there, there's no one monitoring them. We as attorneys don't know what the value of the securities portfolio in the trust is. And if it's not marketable securities, but private equity, a family business interest, I'm not sure if any of the advisors know how that value has changed from the date of transfer to the trust to the current date and whether a swap should or shouldn't be exercised. And, unless, I don't know if any practitioners have blood pressure monitors in their office, but if you're not taking the client's blood pressure, how do you know if their health is deteriorated to know if they need to make a swap? So we need to really take a look at the powers of appointment, swap powers, basis inclusion planning, and monitor all of that. Jonathan, any comments before we go on?
No, but I completely agree with you, Marty.
Tom, do you want to just comment about trust protectors? Any thoughts that you may have about monitoring what they do and making sure they actually even know that they're named as trust protectors? We've seen that too.
So this goes back to when we were talking about the basics and we were talking about creating either a statement or a certification of the various individuals that are named in different positions in the trust. So the trust protector is one of, depending upon how it's drafted, flexible powers in the trust. The trust protector can do anything from removing a trustee, replacing them, changing the situs of the trust. There's many different things that people have given the power for the trust protector. So you need to look at the trust and say, what particular powers are there for the trust protector in this trust? So every single trust, especially if you haven't drafted it, you don't know what's in there because there's really no defined role for a trust protector. It's still a relatively new power that people have been given. So you also need to look at, is the trust protector serving in a fiduciary or a non-fiduciary position in the trust? Because different trusts may name it differently. For example, I know Jonathan prefers to have his trust protectors in a non-fiduciary position. We will often put our trust protectors in a fiduciary position. So it's different based upon what the practitioner and the draft person has done for that particular trust. You need to let the trust protector know what they have there. If they are serving in a fiduciary position, the trust protector should know that they do have liability to the beneficiaries and the individuals of the trust. They may have the ability to request a accounting from the trustee. If they're a fiduciary, do they have a requirement to do that at a certain point? When do they have the requirement to do that? And an important point, going back to representation, the draft person that represents the client that created the trust should make sure to let the trust protector know, I don't represent you, especially if they're in a fiduciary position, because if they have liability, they may try to come back to you as the draft person, as the practitioner, saying, well, you didn't inform me of this. So you need to make sure as a practitioner that anybody that's named in the trust, hopefully, and once again, not setting a standard of practice here, but to protect yourself, anybody that's named in the trust both know that they have the position, that know that the position exists, the kinds of powers that they may have in it, as well as the liability that they have, and the fact that you don't represent them. So coming back every year and looking at these trusts helps you fill in those gaps, because this may be missed one year. Maybe on the first year of review of the trust, there's so much to go over that you don't think of it. But by the second, the third, the fourth review of that trust, you can start drilling down to these kinds of particulars that both help the client, protect the client, and let the people know if they've named what they have and what they need to do for these trusts.
Let me say a few words about trust protectors. And I think I was the first attorney in the United States to use trust protectors, but Alexander Beauvais, a very bright and informed attorney up in Boston, has gotten his PhD on trust protectors. And Alexander has taken the position that a trust protector is always a fiduciary. Well, he and his lovely wife and I and my lovely wife went to dinner about 3 years ago, and he acknowledged that if you did your trust in Alaska, which states that a trust protector is not a fiduciary, and if you also put in the instrument that the trust protector is not acting under a fiduciary cloud, then the trust protector is not a fiduciary. But think about this. I name Marty as a trust protector of my trust, and one of the powers that I give Marty is the ability to remove and replace the trustee. And along the way, the trustee does a horrible act and costs the trust a tremendous amount of money, and I can't get the trustee to pay. Now, is Marty liable? Well, if he's a fiduciary, he should have been monitoring it the entire time. And in fact, I think at a minimum, if you're going to put in a trust protector in a fiduciary capacity, you better say that they don't have a duty to monitor. Can you imagine if you're a trust protector and you have to monitor it to determine whether or not the trustee can be removed? Or maybe what you want to do is that the trustee can only act if requested by a majority of the beneficiaries. And again, you hope that that doesn't give the beneficiaries a general power of appointment, and I think you can do that. But being a trust protector can be very, very scary for someone. And that's why, and I've been the trust protector in many documents, and I've been doing this since 1977. That's when I first learned about trust protectors from some lawyers from Liechtenstein. And I have served probably in 100 capacities, but always as a non-fiduciary. Basically, I'm a person who's given a super special non-fiduciary power of appointment. So in my judgment, you want to go to a state like Alaska where trust protectors are not acting under a fiduciary activity. They don't have fiduciary powers or responsibilities, and you repeat that in the instrument itself. At least that's what I think ought to be done. Not that I have strong views about this, Tom and Marty, but it's what
You've always been very shy, Jonathan.
Yes, that's true.
Always very shy. That's your reputation, in case you weren't aware of that. Shy and reserved and not opinionated. So let me tell you an issue here that I see, and it's going to bite somebody. I haven't seen it bite anybody, but Jonathan, you may, if you have, jump in when I finish saying this. Let's say you're an accountant, and all accountants know Sally very well. Nice person, Sally, but you got to be careful with Sally. Sally, for those who aren't in the accounting world, is same as last year, S-A-L-Y. And an embarrassing story, when I worked at Coopers and Lybrand many decades ago, and I was on my first audit, stupid me, I had no idea what it was. I went up to the senior on the job who had, like a year experience. I had like 2 days. And I said, who's this Sally? Is she here this year? That's when I learned what Sally was. But here's the problem with Sally and trust income tax returns. So Sally, you've been filing a New York income tax return forever, right? And Jonathan, how high is now New York City If you're in New York City, I think the income tax even beats California now. It's over 14% state and city tax.
Yeah, it's just about 14%, Marty.
Pretty painful, folks.
Well,
So
and also let me mention that it's even worse than what you've stated, because the state and the city both do things like disallow certain deductions. Like, let's say you've made large charitable deductions to reduce your taxable income. That will work for federal purposes, but there's a limit for state and federal purposes. So you may find that you're even above 14%. So you've really got to be very, very cautious.
And how does this all, folks, relate to the trust protectors? It does. So if you're an accountant and you've been filing income tax returns paying New York tax that now could be more than 14%, is it 14% wasn't enough of a painful tax bite? It may be that all that's necessary is a simple trust protector action, right? You may have a trustee in New York and the trust in New York and have nothing in the trust but marketable securities that have no New York situs, no New York source income. There may be no New York assets. If the trustee changes the situs and administration of the trust from New York to Alaska and changes Aunt Jane, who lives in New York City, to Peak Trust Company in Alaska, you may now avoid New York income tax. You may be able to change the taxation of the trust. You have to be very careful. There's this natural tendency on all of our parts, especially when you're doing a routine repetitive transaction like an income tax return, is to say, gee, that's what we did last year, that's what we'll do this year. And in the old days, not so long ago, where trusts were irrevocable and we would kind of say they're carved in stone, it's just not the case anymore. And even if you don't have a trust protector that can do that, Jonathan, can't decanting maybe solve the problem of a trust that's paying tax in a high tax jurisdiction?
Well, yes, it can. And also you can make a distribution to a beneficiary who is in a lower tax jurisdiction. I mean, one of the things that you need to ensure that you do, if at all possible, is have the trust located in a jurisdiction which has no state income tax. And there's a very important case decided by the Supreme Court in 2019 called North Carolina versus Kastner, where North Carolina tried to tax the undistributed income of the trust. They won in that case, but it certainly sets forth the premise that by carefully structuring the trust, choosing fiduciaries, making sure as it's administered in a certain way, that you're not going to wind up paying state income taxes. And again, one simple way is where you have discretion is to make a distribution. And section 663, and we all need to be aware of this, is that the 663 rule says that a trustee or an executor can make a distribution within 105 days, which today would put us out to March 5. So you still have, you still may have a little time, not for this year, but for next year, to go ahead and make sure that you've made your distribution, because you can elect to have it treated as last year's DNI. So that way you go, oh my gosh, we have so much income, we're going to owe a fortune to California, to Oregon, to to Pennsylvania, to Connecticut, to New York. And what you can do is to make a distribution within that 105-day period, assuming you have the discretion, so that you can shift that income over to a beneficiary, perhaps a beneficiary who lives in another jurisdiction. It might even be possible to have a trust created, which is not a grantor trust, but a new trust, which is located in a non-tax jurisdiction like Florida or Nevada or Alaska or South Dakota, and have the trust make a distribution to that trust. Again, the shifting of DNI, distributable net income, and Marty and Tom, as you know, DNI, which is defined in section 643A, is just a little bit more complicated than DNA. But you can go ahead and shift the DNI out of the trust to another entity or a person who's not going to be subject to those state income taxes. Very important to consider. And it's one of the reasons, as Marty indicated, you want that annual meeting with the players involved in the trust, including the person who's going to be preparing the tax returns.
Again, folks, we're talking about trust administration, and really critical to trust administration is minimizing income taxation. And I don't see very often the annual meetings I tell everyone they need to have with all of their advisors involved. And again, with web-based meetings, it's not a big deal. You have to have the attorney who wrote the trust and the accountant and the wealth advisor if there's liquid assets, or somebody that knows about the family business if there's illiquid assets, or both if relevant. And you need to talk about, where is this trust paying income tax and can we change it? You may divide a trust into two parts, put the New York or high tax state situs assets in one part and divide the rest of the assets in another part and move that other part to a tax-free jurisdiction like Nevada. You need to address this. It's not done enough. The Sally principle is too risky, and the fact that in the old days we viewed trust as carved in stone and not changeable is just not true. And this needs to be a critical part of trust administration for all trusts. And I'm concerned for those preparing income tax returns, and maybe even if counsel is advising trustees, that somebody's going to come back one day and say, hey, why didn't you tell me? Now, if you tell the client and they don't want to do it because they want Aunt Jane, who lives in New York City, to be the trustee, even if it cost them a couple $100,000 a year in extra tax, that's their decision. But we should try to make sure to inform clients of this to protect ourselves. And if the clients will let us do the planning and let us help them, the savings can be rather substantial. Now, another thing that comes up in trust administration, and we're not going to go through every conceivable thing, but we're just trying to demonstrate, there's lots of different mechanisms and positions created in modern trusts. So one of the positions that sometimes has been used in trust is to give somebody the right to add a charitable beneficiary. That could be done to make the trust a grantor trust. It's another power that taints or characterizes a trust as a grantor trust. That may be done not only to get grantor trust status, which may be assured already because of swap power, but it's done because it's another way to add flexibility. And with the absolute roller coaster over the last 2 years of not knowing from week to week what the tax laws are going to be, and then in the end, nothing may happen, we've all tried to build in flexibility. But if a client's got a power to add a charitable beneficiary in a trust, shouldn't we at some point say, hey, does anyone want to have a charitable beneficiary added? Aunt Jane has the power to do that. Should we have a discussion? Should we have Aunt Jane document that she hasn't done that so everybody has a record that it's never been changed? Tom, you want to talk about loan provisions?
Sure. So like Marty's been talking about, this is another one of the provisions that can cause grantor trust status, but it also creates additional flexibility in the trust. And one of the points that I just want to make very quickly generally is we're always very meticulous, practitioners are, about creating flexibility in trust. But this administration is where that flexibility comes into effect. So even if you have the best crafted trust out there, if it's not administered properly, it's not going to really make a difference. If you put these provisions in and it's never looked at again, then it's almost like not even having the provisions in there at all. But specifically about this loan power, the ability to make loans to the grantor creates flexibility because it gives the grantor the ability to get access to assets that they put into this trust. Over the last several years in 2020 and 2021, because of the concern about the exemption going down, clients may have put a significant portion of their assets into these trusts. If you created a loan power to give them access to those assets because they put 50% of their assets into the trust, maybe even more, and you want to make sure that they had a way to access it, is to talk to them. Do you want to use this loan provision? Is this a way that you want to get access to the trust? If you have several ways for a client to get access to the assets, if they want to get some money out of it, or if there's a concern, which one of those provisions should be used? For example, the loan provision that lets you get liquidity from the trust, but it doesn't reduce the amount of assets that are in the trust. If you, for example, had a distribution to a spouse, if you had a SPLAC, if you make the loan to it, then eventually that's going to have to be repaid by the grantor. That's keeping the assets in the trust. Those are the little nuances that if a client comes to you, you should consider talking to them about. So there's lots here that can be discussed, both about the loan provision and how it ties into the other various provisions you may have put into the trust.
When I find out about clients having borrowed money from their trust, Jonathan?
No, tell me, Marty.
You got to be quick on when I need you to set me up for the line. You know, usually years after the fact, when we're going through random papers that somebody, you know, in the old days it was dumping the shoebox on our desk, but now it's, you know, the random emails of here's some stuff on the trust that somebody just found. What worries me about it, and it's the first bullet point on slide 29, if the trust is a grantor trust and there's a loan provision, that's fine. I worry about lots of the non-grantor trusts we set up with the intent of saving income tax in a high tax state, and then somebody without talking to counsel goes and makes a loan, because now if there's a loan to the settlor, if that loan does not have adequate security, then you've tainted arguably the trust as a grantor trust and undermined the entire income tax intent for the trust. Jonathan, can you define clearly, definitively, with specificity, what constitutes adequate security?
No, we certainly don't know. It all depends upon the facts and circumstances.
So, folks, facts and circumstances, that's kind of risky. If you have a non-grantor trust, you don't ever want, really, I think, a loan being made to the settlor. You got to have another way that you can get money to the settlor than a loan from the trust. So be mindful of all this. But again, what we're talking about, we could go on and on, but it's you got to be mindful of all these types of transactions. I think one of the reasons it's so critical to have an annual review meeting is that the banker, the trust officer, may not understand this issue. The accountant may know about it, but may not understand the legalities of it. The client and the person that holds this power may not understand the incredibly significant tax implications. So we need to be able to meet with the clients and these people and talk about this. This is part of what we need to do with trust administration. And by the way, this is, I think, from Interactive Legal Software, a sample loan provision, just so you can see it. Jonathan, do you know anything about decanting?
I've heard quite a bit about it, Marty. Whereas Marty is teasing because I was the first one to use decanting. And I began, again, doing it in the early 1970s. And the reason I did it was I realized I do virtually nothing and I could make lots of mistakes. So I began adding to the provision to invade for the benefit of the beneficiaries a power to invade by paying it over to a new trust. And I wrote the first, that was wonderful. Within 6 months of adding it to my trust, I would have people come in and say, you know, we want to change the terms of the trust. I want, you know, I'm now divorcing this man and I want him out of the trust. Extremely powerful. In fact, my dear friend Carlin McCaffrey told me that the legislation I got for New York, which is EPTL 10-6.6, which New York enacted in 1991, was the most important legislation passed in her career. Now, she may have changed her mind, but that's what she said. It is extremely important. And you can either go to a state and have it, but I urge you to consider having decanting provisions right in the trust from inception. And as Marty was indicating, a lot of these forms come from Interactive Legal, and we have a very, very broad decanting provision there. It allows you basically to do an amendment to the trust in order to save taxes or to avoid liability problems or for virtually any reason at all. And even though there are lots of powers now granted to trustees under state law, like the ability to divide trusts, you may, for example, want to give a beneficiary a general power of appointment to get a stepped up in basis when the beneficiary dies, or even a limited power, and then you can decide to either use or not use the so-called Delaware tax trap, section 2041A3, to have it included in the beneficiary's estate or not. Decanting is exceptionally important, and I don't know how many states have it, but it's got to be approaching 40 now. And of all the laws I've written, I think it's had the broadest impact ever. It's very, very important. First, at the beginning, people, you know, said, why do you have this in New York? And then I got it in Alaska, and then Delaware came along, and from people saying, you know, what's this provision? Why would I use it? It's become one of the darlings of the estate planning bar. Did that answer your question, Marty?
Yeah, but I have another question. How do you identify a client that's going to be most likely to want to decant a trust? Do you know?
Yes, his name is Everyman. I had a wonderful, wonderful client who's still a great friend of mine who did an enormous trust, and we had 4 law firms involved. And I was the principal drafter, and the client said, I'm not signing this trust because you have this decanting provision, and I want decanting absolutely prohibited because I know exactly what I want and I'm never going to change my mind. And I refused to put the trust in final form. So one day he called me, cursed me out, and said, all right, put it in. Now, that was in 1999. We are now doing our 5th decanting. Things change, attitudes change, needs change, laws change. You always want a decanting power. Now, in the ILS forums and also under New York state law and Alaska law and virtually every state that has it, you can't do a decanting which would cause a tax benefit to be jeopardized. So if you have a marital deduction trust, you can't take away the beneficiary spouse's income interest. But by and large, you want to have decanting. It is a most powerful provision. And so the answer, Marty, is every client, I don't care what they say, they are going to need decanting.
I was going to answer it a little differently. The clients I find most likely to want to do a decanting are the ones that tell you when you're drafting the trust, I want this carved in stone. I don't want anyone to ever change it. The more adamant they are, they're never going to change it. It seems that, you know, they're more likely to be the ones that want to change it. Apropos to our topic, folks, of trust administration, the existence of decanting statutes, I think, Jonathan, you said 40 states. I know it's the significant majority. The fact that many trust instruments include decanting powers, and even if you don't have a decanting power, even if your state doesn't have a decanting power, you may be able to change situs and governing law of a trust to a state that does have a decanting power and decant it under that state's law. So the point is that it changes trust administration, I think, profoundly from what it was 10 years ago, 15 years ago, in that part of the discussion with every client when we're administering a trust might be, you know, hey, are there things here you don't like that we might want to change? Are there things that we can improve? We talked about trust state income taxation, but there are a whole raft of things that might be modified in a trust. You can't sally a trust. You can't assume that because it's an irrevocable trust and what you have there, it's fine. I think it now creates a greater responsibility for all of us as practitioners to be able to explore better options that may now come to light, or better drafting techniques that now are available that weren't when the trust was done. And then we need to talk to the client about the possibility of decanting. We've talked about swap and substitution powers. Let me just make a comment. You know, people think of a swap power solely in the context sometimes, I got a highly appreciated asset in trust. I'm old, I'm on my last legs, I'm going to swap it out to get a basis step up. But a swap power can be so much more. So, example, we've had this. Dad put business in trust, son was running business, and son wanted to be involved in the business, and he structured a trust that was not very flexible and had this business in it, and he was going to benefit the trust and so on. And we swapped the business back out, and then he regifted it and changed the whole dispositive plan. So think of it in fairly broad terms. Jonathan, I know we're getting short on time. Do you want to comment on powers of appointment? We've kind of already covered it. I don't know if there's more that we want to cover.
Well, Marty, powers of appointment are an exceptionally powerful tool to have for estate planning. I've always put at least limited powers of appointment in there so things again can change. The beneficiaries can change it. But, you know, I got more conservative as time went on, and I would say that each of the children had a special power of appointment, which again normally could be exercised to trigger the Delaware tax trap to cause estate tax inclusion. But one of the reasons that you want to have it is because things do change. But I began to say it could only be exercised with the consent of the independent trustee. So, you know, if I were married to your daughter, Marty, you can guarantee that she would do everything I want. And I would say, sweetheart, you have to exercise that power of appointment in my favor and not to your children's favor. But if she's got to go to the trustee, let's say it's Tom, and say, well, gee, I now want to exercise his power and give it all directly to my husband, Jonathan, maybe Tom is going to say no. So the beneficiary can play good cop and the independent trustee can play bad cop. So I urge the use of powers of appointment, but I also suggest that you put some sort of kind of a sling around the exercise by saying it can only be exercised by the consent of an independent trustee. That really is going to protect the family and yet provide tremendous amount of flexibility.
The key to our topic of trust administration is there's, Baskin and Robin, 31 flavors of powers of appointment. I mean, there's so many different variations. We have to identify what the specific parameters are, what bells and whistles, what fences, what hoops have to be jumped through to exercise them, what they do from a basis step up if that's applicable, because it's going to be different in almost every situation. And we need to identify that and make sure that everyone understands it. And I think this is also a sample power from Interactive Legal. So let's skip through the rest of powers of appointment. Jonathan, I think we've covered an awful lot. I'm not sure we really want to continue much longer in terms of time to go through slats. I think we may need to do part 2 of trust administration. Any thoughts? Jonathan?
Yes, let's have part 2.
Okay, so I think we should wrap up, folks.
Yes, Marty, let's have part 2.
Okay. We'll schedule a part 2 for this program and cover the latter half of it. I hope that this was practical and useful. We really tried to focus on not so much technical as very practical implications of trust administration. We tried to give you some of the practical, non-technical ways that we deal with very common trust administration issues, from the basics of creating a trust permanent file, if you want to call it that. Jonathan discussed a workflow. Tom discussed schematics and tables of contents, checklists, and closing binders that we create. And then for the rest of the program, we've talked about really a pretty substantial range of different types of issues that come up with trust administration. And Jonathan, I think, carried the ball in terms of explaining a lot of these mechanisms, and I just tried to point out how the mechanisms have to be evaluated in terms of trust administration, which is our topic. It is not a simple topic. It is very unique facts and circumstances to each client. I think that the gold standard is to have an annual review meeting with everyone involved in the trust, everyone affected by the trust, and make sure all the advisors are involved as well. Sadly, that does not happen very often. We try to get it done. We recommend it to 100% of our people, our clients, and it's a very, very low compliance rate, unfortunately. But I think just from the topics we've covered, you can see the myriad of different issues that do need to be addressed. Jonathan, do you want to make any last comments before we wrap up?
Marty, I just can't wait to part 2.
Your life is so exciting that this is going to be a highlight, huh?
You betcha.
Tom, any last words of wisdom?
Oh, the last thing I really want to emphasize, and you kind of touched on it during your wrap up, is there really should be collaboration between the various parts of the professional team. We have during this conversation talked about the accountants, we've talked about the financial advisors, we've talked about the insurance advisors, the appraisers. You can bring together during an annual review the various disciplines and everybody that's involved, because everybody's going to have a different viewpoint. I think one of the better examples is the swap power. We mentioned the fact that the attorneys aren't going to know if there's any appreciated assets. If you have an update meeting, if the attorney has an update meeting with the client without involving the financial advisor, are they really going to be able to answer that question? If you have the financial advisor there and you talk about a swap power, they can hopefully very quickly get you an answer on if it makes sense to exercise one at that point. So by collaborating, you are creating a fuller review of the trust, and it's giving you a better chance to better serve the client in administering these trusts.
Good point. And that's really the gold standard we all want to work towards, of a collaborative team effort on periodic trust administration meetings so we can identify all these things. And I believe that clients will benefit tremendously. The biggest impediment, I have no doubt, is one thing: money. Clients get concerned. Oh my gosh, I'm going to have, you know, multiple attorneys, accountants, and all these people billing me to review a trust. But you know what? When we've had that done, the benefits have been tremendous. When clients permit us to have a collaborative review of a trust administration, we've seen significant benefits to the client. Sometimes it's not money saving, sometimes it's just simplification or ease of administration, but it's always been very, very beneficial. So thank you for joining us, and we wish you all good luck and care in your trust administration.